You run your freelance business from your personal bank account. Income hits the same account as your salary. Business expenses mix with rent, groceries, and petrol. At year-end, you hand your accountant a year of bank statements and ask them to separate the business from the personal. Two things have happened. First, your accountant will charge you significantly more because the work is genuinely difficult. Second, the IRS will view your commingled records as unreliable substantiation for any deduction you claim. And if you have an LLC, you may have just handed any future creditor the legal argument they need to reach your personal assets. The IRS does not require self-employed individuals to maintain a separate business bank account as a legal matter. Schedule C does not have a box that asks whether you kept separate accounts. But the IRS does require that you substantiate every deduction claimed on your return. When personal and business transactions share an account, every expense becomes ambiguous. Was that restaurant charge a business meal or a personal dinner? Was that Amazon purchase supplies or household goods? The burden of proof rests with you. Commingled records make it impossible to meet that burden cleanly, and IRS examiners are specifically trained to look for it. The liability protection argument is separate from the tax argument and is, in many ways, more costly. An LLC's liability shield depends on the entity being treated as a genuine separate legal entity, not as an alter ego of its owner. Courts in most states apply what is known as the alter ego doctrine to pierce the corporate veil. If the owner has commingled personal and business funds, used the business account to pay personal expenses, failed to maintain separate records, or treated the business as a personal instrument rather than a separate entity, a creditor can argue the LLC is fiction and reach the owner's personal assets. The LLC protects nothing if the separation was not maintained. Opening a dedicated business bank account requires, at minimum, your business name, a tax identification number, your EIN or social security number for a sole proprietor, and in most states, your registration documents if operating under a business name. Most major banks offer free or low-fee business checking accounts. Credit unions are often the lowest cost option for small businesses. Online business bank accounts, Relay, Mercury, Novo, have no monthly fees and are specifically designed for small business use. The account costs you nothing meaningful to maintain, and the financial discipline it creates has compounding value over the life of the business. The operational rule is simple. All business income, invoices paid, client transfers, platform payouts, goes into the business account. All business expenses, software, supplies, contractor payments, travel, are paid from the business account using the business debit or credit card. When you need personal funds, you transfer a defined amount from the business account to your personal account as your owner's draw. You never pay personal bills from the business account. You never deposit personal money into the business account to cover a shortfall without documenting it as a documented capital contribution. Clean separation in, clean separation out. A dedicated business credit card, as opposed to a business debit card, offers additional advantages. It creates a natural monthly statement that serves as an expense record categorized by transaction. Many business credit cards offer expense categorization, receipt matching, and accounting software integration. The float, typically 30 days between purchase and payment, helps manage cash flow. Business credit card charges are deductible in the year the expense is incurred, not when the card is paid. And unlike a debit card, a credit card provides purchase protection and fraud dispute rights that matter when business transactions involve significant amounts. Bookkeeping in a separated account structure is dramatically simpler. Every transaction in your business account is either income or a business expense, no filtering required. Monthly reconciliation takes 30 minutes instead of hours. Year-end tax preparation involves exporting a bank statement and matching it to your accounting software records, not reconstructing 9 months of mixed transactions from memory and bank statements that contain personal grocery bills. The time saved in bookkeeping alone justifies the separation. The audit protection is a bonus. The liability shield maintenance is the third benefit that most self-employed people never consider until they need it. If you have been commingling for 1 or more tax years and want to correct it, do not attempt to reconstruct prior years by guessing which expenses were business. Instead, from today forward, open the business account, migrate all business income and expenses to it, and use the clean new records going forward. For prior years, work with your accountant to identify clearly identifiable business expenses, not ambiguous ones, and document those only. In an audit of a prior commingled year, being conservative in what you claim is safer than claiming everything and being unable to substantiate any of it. For S-Corp owners, separation is a legal compliance requirement, not just a best practice. Your S-Corp is a separate legal entity. Its bank account and your personal account are two different legal entities' accounts. Paying personal expenses from the S-Corp account without proper documentation can create constructive dividends, taxable distributions to you as a shareholder, or disallowed business deductions. Either consequence increases your taxable income. S-Corp accounting commingling also attracts IRS scrutiny because it suggests the officer's W-2 salary may be artificially low, which is the primary S-Corp audit trigger. A separate business bank account is the foundation of every other financial system in your business. It makes your deductions substantiable, your bookkeeping manageable, your liability protection real, and your year-end tax preparation efficient. It costs nothing to open, takes an afternoon to set up, and produces benefits that compound every year. The alternative, commingled accounts and the chaos they create, is a structural risk that grows more expensive to untangle with each passing year. If you want to understand the minimum bookkeeping your business actually requires each month, our video on bookkeeping for non-accountants covers the exact rules.